Hi, I'm Nathaniel Ekman. I'm a senior analyst here at ValueLine. I'm joined today by two other senior analysts, Alan House and Charles Moran. Today, we're going to provide an update on the economy and stock market. We will then recommend our one stock to buy right now and, finally, answer your questions. Please note that this presentation will be available on our website, www.valueline.com, and on our YouTube channel within the next 48 hours. All previous webinars are also posted. Before I jump into the heart of the presentation, for those joining us for the first time, I want to provide a brief overview of who we are at ValueLine. We are a New York headquartered corporation that has been providing investment research for more than 90 years. Our flagship product is the ValueLine Investment Survey. This service is a unique source of financial information and is designed to help investors make informed investment decisions that fit their individual goals and levels of risk. The product includes data, information, and analysis on equities that trade on the New York Stock Exchange, the NASDAQ, and the Toronto Stock Exchange. It also includes economic commentary, easy-to-follow model portfolios, stock screens, industry-based analysis, and much more. This service, which is published weekly, is created by ValueLine's research department, which is comprised of nearly 70 analysts, economists, data experts, and quantitative specialists. One thing I want to stress is that our research is completely unbiased and independent. Unlike many Wall Street brokerage firms, ValueLine has no investment banking business with any company, including all the equities under our coverage. ValueLine does not execute trades for its subscribers, and therefore has no vested interest in whether our subscribers buy, sell, or hold a specific equity. What's more, our staff of professional securities analysts are not permitted to own shares of any company that they cover. If you have any questions about the products or services we offer or our different tiers of subscriptions, that information can be found on valueline.com, or you can call 1-800-VALUELINE. Now, let's discuss the economy and the stock market. This content was prepared by ValueLine's economic staff. The United States and China have agreed to pause most of the tariffs between the two nations. They will attempt to renegotiate a comprehensive trade deal. Specifically, the 90-day moratorium will drop American tariffs on Chinese goods from 145% to 30%, while China has agreed to slash retaliatory duties from 125% to 10%. It was a positive development in the ongoing trade war, which has functionally been equivalent to an embargo, with few shipments moving between the two nations. This rate reduction will increase trading activity, and President Trump added that the pause on most levies could be extended, assuming good faith negotiations to finalize a deal continue. The increased trading activity between the world's two largest economies lessens the odds of a recession on these shores. There is also renewed hope that inflation will remain on a downward, albeit slightly uneven, trajectory if consumers are not forced to pay higher prices for goods this spring and summer, resulting from fewer foreign-produced options. Inflation at the consumer and producer or wholesale levels may also be helped by deregulation in the energy markets and the possibility of lower prices for oil and natural gas during the second half of this year. The April Consumer Price Index, or CPI, report was encouraging. The CPI and the core CPI, which excludes the food and energy components, increased 0.2% month to month, with both coming in lighter than expected. On a one-year basis, the CPI rose 2.3%, with the pace of growth moderating from the 2.4% increase recorded in March. All in all, it was a constructive report for the Federal Reserve in its goal to rein in inflation. First quarter earnings season was a success for corporate America, with nearly all of the S&P 500 companies having reported as of press time. More than 3/4 beat profit expectations. Profit growth, on average, was around 14%, which would mark the second consecutive quarter of double-digit advances. In conclusion, some positive trade developments and a surprisingly strong first quarter earnings performance helped the major averages retrace the early April tariff-driven setbacks. That said, given the fluid nature of global trade negotiations, we continue to recommend that investors maintain a diversified portfolio led by stocks of high-quality companies. Please refer to the inside back cover of Selection and Opinion in the Value Line Investment Survey for our statistically based asset allocation model's current reading. On that note, Value Line provides a great deal of information and analysis to help our subscribers. We know that most of our users depend on our weekly stock reports, time-tested ranking systems, and other valuable services. To that end, we're constantly working to improve our offerings to ensure the best possible experience for our subscribers. Our latest innovation in that regard is the Value Line Digital Booklet, which offers our subscribers a powerful new tool to see the information we provide digitally in a faithful reproduction of its original printed context. To access the digital booklet, you'll go from the dashboard to and then click on the investment survey under traditional online access, which will bring you to this page. From here, the digital booklets from both current and back issues can be accessed. So once the digital booklet is opened, navigation is as easy as flipping the page. Or, alternately, you can jump to a specific bookmark using the sidebar, which is conveniently organized by industry. So, on top of our regular reports, Value Line provides additional daily content on markets and individual companies that can help you avoid the pitfalls and profit during this volatile time in the stock market. Every business day, senior members of Value Line's research department Senior members of Value Line's research department review the most actively traded stocks, company press releases, news stories, trade periodicals, and other sources for data and information that may change our view and investment recommendations for specific stocks. When something noteworthy crosses our desks, we immediately publish a supplementary report that outlines the new information and, importantly, what it means for the stock and shareholders. This content is posted throughout the day on our website. Again, that's valueline.com. I will now show you how to access these reports. First, you'll head to the dashboard. Then, under the Quick Links section, click on Supplementary Reports. As you can see, the research department has been busy publishing our updated thoughts on the stocks that we track. We strongly suggest that subscribers visit this page often. Some individual companies incurred a lot of debt or sold stock to improve liquidity over the past few years, especially those dealing with sharply reduced demand for their offerings and supply chain problems, among many other issues. Due to the changing structure of company balance sheets, Value Line has been reviewing and altering our proprietary financial strength grades for the stocks in our coverage universe. These changes are posted each week in our Selection and Opinion newsletter. For those of you that don't know, financial strength, along with price stability, another proprietary Value Line measure, are the two metrics that are used to calculate a stock's safety score, a measure of risk. When considering a new stock to invest in, we strongly suggest you utilize financial strength and safety in your decision-making process. For more information regarding our proprietary ranks and ratings, Value Line provides a user guide that can be accessed via the investment education section of our website. Lastly, this is a good time to mention that the case for individual stocks is quite strong over broad index funds. Now, let's move on to the one stock to buy right now. For this, let's go first to the screener. Value Line subscribers have access to 15 preset screens and 50 fields. I should also mention that another 100 or so fields are available but require a higher level of subscription. If this interests you, please call 1-800-VALUE-LINE. As noted in our economic commentary, although the tariff situation appears to be improving, there remains a great deal of uncertainty. Accordingly, today we're going to be looking for stable, financially strong companies that are well positioned to outperform the market at large. We're going to start by applying our time-tested safety ranks. Safety measures the total risk of a stock and is arranged on an easy-to-understand scale from 1 to 5, with 1 being the most conservative issues. I want to highlight the fact that while stocks are ranked favorably for safety, have in the past held up far better than the broader market during corrections and downturns, they also meaningfully participate in up markets. For more information, I encourage you to peruse our ranking system guide, which is available free of charge from within the investment education section of our website. Today, we're going to focus on stocks with a safety rank of 2 or better. By applying that first criteria, we've trimmed away our potential candidates down from 5,700 to 401 candidates. Next, we're going to filter for timeliness. The timeliness rank is used to predict the relative 6 to 12-month performance of stocks in the value line universe. The format is The format is an easy-to-understand scale from 1 to 5, with 1 being the best performing issues on a relative basis. Most often, stock buyers will want to avoid stocks ranked 4 or 5, while stocks ranked 1 or 2 are considered above average. Today, we're looking for stocks ranked 2 or better. Applying that filter, and we are now down to 104 candidates. Today we want a stock with strong momentum, so we'll be looking at issues that have generated a total return of at least 10% over the past year. And with that filter applied, we are now down to 46 candidates. We also want a stock that will generate solid returns over the longer term. To screen for those, we'll be looking for stocks with 3 to 5 year total return potential of at least 15%. Applying that filter, and we find ourselves down to 13 candidates. Finally, because we want a company with the financial strength to weather the current environment without any potential issues, we'll be limiting our search to those with a financial strength rating of at least A+. Applying this screen, we've chipped away the list of prospects down to the final 6 candidates. And those are Amphenol Corp., ticker APH, Checkpoint Software Technologies, ticker CHPK, Monster Beverage Corporation, ticker MNST, Sony Group, ticker SONY, The Travelers Companies, ticker TRV, and Total Energies SE, ticker TTE. You can make a case for any of our remaining candidates, which span a number of different industries, and investors interested in adding new positions should consider them. However, only one can be today's one stock to buy right now, and after consulting with a number of our senior analysts, we prefer and recommend Sony. Before I click on Sony, please note that screens can be saved and revisited by utilizing the Create Saved Screen button at the top of the page. Now, let's take a look at Sony Group. One of Japan's largest companies, Sony Group is a multinational conglomerate with operations spanning electronics, film, music, video games, and more. While a wide variety of the company's devices and content are popular in the United States, it's perhaps best known for its PlayStation line of video game consoles, and its game and network services division generates the largest portion of its revenue. In addition to the consoles themselves, this includes the rights to many of the world's most popular video game franchises, such as God of War, The Last of Us, and Uncharted, which are playable not only on Sony's machines, but also competitors' consoles and personal computers. Indeed, Sony's vast library of intellectual property, which spans not only video games but also music, film, and television, is in many respects its most unique and valuable asset. In recognition of this, the company has been working to expand its library through strategic acquisitions, an approach with which our analyst is inclined to view favorably. Beyond the company's fundamentals, we were motivated to choose Sony this month by an unusual circumstance created by the ongoing tariff situation. Last week, Sony announced its full-year results for its 2024 fiscal year, which ended in March. This included guidance for the year ahead, which reflected the potential impact of tariffs on the business. Several hours after Sony's presentation, the White House announced that tariffs on China would be cut. In other words, Sony's 2025 guidance is only a week old, yet already out of date and potentially lowballing the company's results. As a result, there's reason to believe that this information gap may represent a good buying opportunity. In conclusion, we believe that Sony is both financially strong and well-positioned to grow in the months and years ahead. It is today's one stock to buy right now. We will now tackle your questions. Please note that I typically can't answer complex questions about specific stocks on the spot. For this, I recommend a review of our latest reports. The first few questions were submitted prior to this presentation. Now, I'll hand it off to Alan and Charles.
Thank you, Nathaniel. This is Alan. Thank you all for joining us today. I have a couple of good questions that came in. The first was, I was interested in knowing what the three figures in the bottom right of the value line page mean. Earnings predictability, stock price stability, and price growth persistence. And I'm going to bring Sony's last value line report up from March 21st, 2025. And this is the question that was asked. What do these three variables right here mean in the bottom right of the page? So I'll go through that. Excuse me. Earnings predictability is a measure of the reliability of an earnings forecast. Predictability is based upon the stability of year-to-year comparisons, with recent years being weighted more heavily than earlier ones. The earnings stability is derived from the standard deviation of percentage changes in quarterly earnings over an 8-year period. The most reliable forecasts tend to be those with the highest rating, which is 100. The least reliable would be the lowest rating, which is 5. The price stability rating is a relative ranking of the standard deviation of weekly percent changes in the price of a stock over the past 5 years. The ranks go from 100 for the most stable to 5 for the least stable. Finally, the price growth persistence is a measurement of the historic tendency of a stock to show persistent price growth compared to the average stock. Value line persistence ratings, again, they go from 100 highest to 5 lowest. There was another very good question that came in. What is Value Line's target price range? And if I go to the top up here, they're talking about this right here, the 28 to 2030 projections. For Sony, it's 40 as a high and 30 as a low. So they wanted a little more detail into that. And when your strategy is long-term growth, your goal is to buy stocks with potentially above average price appreciation. Our analysts derive 3 to 5 year target price range is one of your most important tools for identifying these stocks. Target price range is a forecast of where Value Line expects the average price of a stock to be in the next 3 to 5 years. The range is based on our analysts' informed estimate of company earnings during this period, multiplied by the analyst's estimated price earnings ratio for the same period. The difference between a stock's potential high and low prices depends on the stock's safety rank. Expect a stock with a high safety rank to be more stable and therefore to have a narrower band. A stock with a low safety rank is likely to be more erratic and therefore have a wider range. High safety meaning like 1 or 2, low safety meaning 4 or 5. Just wanted to clarify that. Because the analyst calculates the target price range using an estimate of future earnings based on information available at the time it is calculated, this measure can be somewhat subjective. As company performance changes in the future, the target price range will also be altered. Thank you.
I got a question, Alan. This is Charlie Moran. It's regarding the future of the PS business and increasingly competitive gaming landscape. The PlayStation operations are a big part of the entertainment division. It accounts for roughly half of the overall revenues. They're about approximately a third, depending on the time of the product cycle. PlayStation 5 is doing very well, and monthly active users should continue to expand. The monthly active user rate, I believe, was 129 million, and that was a record in the most recent quarter. Spending per user is trending higher, and management is trying to augment profits through personalization measures and creating a larger average revenue payment per user. PlayStation Plus is also another avenue for growth. Stronger profitable peripherals like the Beta Cloud streaming feature will also help in the future. And finally, Nate hinted at this as well with regard to the library and the enormous IP library that they have. They're also, they mentioned the fact that they have a tremendous prospects with Crunchyroll, which is their streaming online anime business that they're going to also emphasize in the future. So all in all, I think the PS business looks very strong for the coming year. And I didn't really see any other questions. Did you, Alan?
Actually, one just came in. Someone just asked if I could show them again how to access the digital booklet, and that's a very good question. To access the digital booklet, you go to the dashboard, and then you go to the traditional online access, click on investment survey, and then you just click on investment survey digital booklet, and that'll bring that page up. This is a relatively new product for Value Line, and it's, I think very interesting. You get the feel of flipping through the pages digitally. So I just want to address that
Yeah.
question.
Yeah. I've got one here. How do Google's two tickers, GOG and GOGL, differ? Would they have identical fundamentals since they're the same company? And if not, what would be different? So this one, it is about a specific company, but I can actually take this. The difference is the share class. Basically, the GOG are Class C shares, which means they don't have voting rights. In terms of, the underlying fundamentals, they are the same company, and if, voting is not something that you're interested in, then those are potentially, the way to go for you. So.
Thank you, Nate. That's all the questions that I see for today. I thank you all for joining us, and I'll hand it back to DJ.
Actually, I do have
Sorry.
one more. This
Sorry.
one just came in just as you were wrapping us up there. But it is where does PlayStation stand versus Xbox? Do we get to see any write-up on the competition? So Xbox is Microsoft's gaming platform. And so if you wanted to look at that, you would want to look at, Microsoft's performance. But the thing to note here is that traditionally, those two consoles have been defined by, this very stiff head-to-head competition. But just over the last several years, that dynamic has somewhat shifted as Microsoft has strategically pivoted from being very focused on the physical item of the Xbox to trying to build more of an Xbox ecosystem that also encompasses, Windows computers and that sort of thing. And the result of this has been there is definitely still competition between the two devices, but it's not quite what it used to be. This was alluded to in the presentation when, tying specific, games and software exclusively to one platform or the other is less of a thing now than it used to be. And so the competitive dynamic between those, it's not quite the horse race that it used to be. Now it's much more, in some ways, about it's not about exclusivity and this single ecosystem. It's about, well, in terms of the devices, it ultimately comes down to, consumer preference and quality. And in that respect, it remains somewhat tied. If anything, though, Microsoft is giving ground because they're focused more on the overall ecosystem than the specific device. Um, but the bigger thing is that now, since they're trying to distribute their content licenses on each other's platform, rather than just keeping that exclusive, the quality of the content really matters there, and that's something that Sony is sort of leaning into with, their increasing focus on content strategically. Um,
Okay, thank you, Nate. I actually another one did come up while Nate was answering that question. Is someone asked there a certain time you strive to post the daily reports on stocks, and that's a very good question. And the answer to that is is basically as soon as possible. We do daily supplements, based on breaking news, and obviously we need time to analyze the stock, and we try to get that information onto our website as soon as possible. There's no set time, but as soon as that information is available, we analyze it, adjust our estimates if necessary, then we post that information on our website. So we like to keep our subscribers current, in that sense. So that's the answer to that question. Thank you.
all right. I think that um, there's one other question which I think is worthwhile, which is, given the, very volatile on again, off again situation that we've seen with tariffs here, how does that affect our buy recommendation for Sony? And I would say it doesn't, because a large part of the reason we chose Sony is, yes, there is that opportunity there, but also it's a very rock solid company financially. And so part of why we chose it is we think it's well equipped to deal with whichever way this situation goes, right? Um, and I think that's our questions for today. So,
Okay, well, thank you all for joining us, and now we'll send it back to DJ. Thank you.